Hello and welcome to this October 2022 Investment Outlook video from Fidelity. I'm Ed Monk and I'm joined today by the Outlook's author Tom Stevenson to answer your questions about where Tom thinks markets are now and where they may be going in the months ahead. Now, Tom, as always, we've asked Fidelity investors to submit their questions to you in advance, and I'm pleased to say that a great many have done just that. I'll add here that these are Tom's views of the market. It is not investment advice, but should be only seen as guidance. That said, Tom, let's put some of those questions to you now. And the first one is a question that relates to a topic that a few people have asked about, and it is this. It says, I hear conflicting stories about the bond market, especially as we know the government needs to borrow to fund its programmes. What are your thoughts on the current desirability of bonds? So what do you have to say, Tom?
Well, that's an interesting question. And, you know, for many years, we've talked about bonds and been pretty negative on them. And the reason that we've been negative on bonds is that the yields, the income that they offered investors was pretty paltry. In fact, almost non-existent, even negative in some cases, in some markets. And of course, when bond yields are very low, as they have been, the prospect is that bond yields will rise, and you know, as we've discussed many times, bond yields and bond prices move in opposite directions. So rising bond yields is bad news for investors. So that's why we've been negative on them in the past. I think the situation now is very different. Bond yields have risen a lot as investors have worried about rising interest rates and inflation. And now we find ourselves in a situation where bond yields are pretty high. Bonds are offering, you know, a pretty decent income to investors. And in addition to that, and this is important, with the prospect of a deteriorating economy ahead of us, we now also have the possibility that bond yields may fall from current levels. And of course, that works in reverse. Falling bond yields equals rising bond prices. So I think investors actually now face the possibility of being able to lock in a decent income from their bonds and to, you know, have the expectation that maybe they can make a capital gain as well. So I think bonds look pretty interesting at the moment.
And the question about the desirability, it does relate, doesn't it, it relates to your view of the future and what's going to happen to inflation and to growth, because yields at these levels look good, they're great compared to the last 10 years, but that only makes sense if inflation falls back a bit, because if inflation is very high, then they're still lagging some way behind.
Yes, and I think the expectation is that in due course, inflation will start to fall back, and indeed, you know, we're expecting some inflation figures this week, which may start to confirm that trend. So that's all part of the story of falling bond yields and therefore rising bond prices. The other point to maybe mention about bonds is that traditionally they've acted as a counterbalance to shares, to equities in a balanced portfolio. And this year they've not done that because interest rates have been rising. That's been bad news for both the stock market and the bond market. So it's been quite an unusual situation. If we do find ourselves going forward in a situation where the economy is slowing, and maybe that's not so good for the stock market, it might be good for the bond market, they may start to move in opposite directions again. And to provide the diversification benefit, which has always been one of the attractions of investing in bonds.
Okay. Well, Tom, let's move on to the second question for now, and it is this. Hi, my investment account has gone down 15% over the last 18 months. I deliberately chose a diversified spread of 10 supposedly low-risk funds. I was, of course, prepared to accept some volatility, but certainly not to this extent. What is your best guesstimate, please, at how long it might take to recover the loss if I sit tight, as I'm considering a fund switch in the hope of some improvements? So, general thoughts about that, Tom?
Yeah, well, I mean, I think 15% strikes me as being a pretty normal correction and something which someone investing in the stock market should not be particularly surprised by. I mean, no one likes to lose 15% of your money, and depending on where you are in your investing life cycle, if you're coming up to retirement, for example, that might seem pretty alarming. But in the great scheme of things, a 15% correction is normal, and in due course, you know, I'm quite sure that it will be it will be clawed back by the market. I think if you're investing in the stock market, you have to accept that there are ups and downs. It is the price that we pay for the long-term outperformance of shares compared to other safer asset classes. As we saw at the beginning of the pandemic, when we had a much bigger fall actually than 15%, it recovered pretty quickly. So, my guess is that once the market stabilises and picks up again, it won't take that long for that to be recovered.
Yeah, a couple of things that jumped out at me reading this question. First of all, we don't know exactly the nature of the fund. They've said they're low-risk funds. So I would suggest, even at a 15% fall, they've probably done their job, because actually the wider stock market, certainly a global tracker-type fund would have fallen by more than that, I suspect. Certainly a US fund would have fallen by more than that. And what we can't tell is the gains I presume that they've made in the preceding 2 years, where gains have actually been quite strong. So you have to see it across the whole sweep, and I agree with you. If you're invested for the long term, you can expect 15% falls pretty regularly. You hope that there's more frequent, better years, but certainly that's not very unusual.
Yeah, and I think you're absolutely right to point out that probably in the previous 2 years, the gain was considerably more than 15%. So it's important to look at the cycle in the round. And of course, it's human nature. We tend to focus more on the 15% losses than we do on maybe the 35% gains. That's human nature. It
is. Well, let's move on for now, Tom. And an interesting question. We had a few on this topic concerning recent events. It says, if the UK government is pursuing a growth strategy, including increased borrowing, and the Bank of England is determined to control rising inflation via interest rate increases, are we seeing a divergence in competing priorities and strategies? My thoughts are, yes, we are. So what are the long-term implications for the economy?
Yes, well, I'd agree with the premise of the question, that we are seeing an inconsistent policy between the government and the Bank of England. The Bank of England, of course, is independent from the government. Its job is to control inflation primarily, and that is what it's trying to do by raising interest rates. The government, of course, is in the business of, managing the country, but also getting re-elected, and we know that there will be an election within the next 2 years. So it's in the government's interest, clearly, to stimulate growth in the economy. Now, all other things being equal, stimulating growth is going to make the inflation situation worse, which is going to force the hand of the Bank of England to raise interest rates further than it would otherwise have had to do. So I think the consequence for the economy of this divergent approach is that we'll probably see interest rates going a bit higher and maybe for longer than we would otherwise have seen. So that's not necessarily a good thing, but you can understand the different motivations of the government and the bank.
Yeah, absolutely. It's been fascinating to watch fascinating, a little bit scary, but fascinating nonetheless, to watch the last few weeks. Politicians, elected politicians, for them, growth is 100% a positive thing. And it's a very difficult thing to communicate to an electorate that actually there are some occasions when you don't want growth. And the reality is, with inflation being so high and the Bank of England trying to control it, probably it needs a slowdown in growth. Maybe it even needs a recession to bring prices under control. That's a really hard message to convey to normal people, because we want pay rises, we want growth, we want employment opportunities. But the reality is that the Bank of England has had to try to engineer a slowdown in growth, and markets saw what the government was doing. And I think this is sort of underappreciated in terms of the mini budget a few weeks ago. It just took a snap decision. It said, this is going to be inflationary. This is going to make the bank's job harder. We're out, we're selling gilts, and what have you. And that's the sort of, as this questioner has alighted upon, that is the conflict we seem to have.
Yes, absolutely. And I think that you need to recognise the danger of allowing inflation to get out of hand. And if you roll back to the early 1980s, when this was last a really serious problem, the Federal Reserve, under Paul Volcker, the head of the Federal Reserve then, made the decision that snuffing out inflation was the key priority, and they would be prepared to do whatever it took in terms of growth to do that. And with the benefit of hindsight, you can say that was the right decision. But at the time, for many people, it did not feel like the right decision. It felt like it was a terrible time for businesses, for households. But these are the tough decisions that they have to make.
And just finally on this question, the question is asked about, what are the implications for the economy? It's a bit early to say, isn't it? Because clearly I think the government's had its fingers burned with the market reaction to what it's done. So we're going to have to wait and see exactly how it treads its path now, what considerations it has towards the market and the market's fear that we're going to get more inflation, higher interest rate rises.
Yeah, I mean, the new government is clearly finding its feet and deciding. It's got an agenda which it wants to push, and it's finding its feet in terms of how aggressively it can pursue that agenda and keep the markets on side, which is clearly important.
Okay. Well, we'll move on for now, Tom. And this question is broadly speaking about the UK market. It says, I have always looked to invest in low-cost ETFs on a medium to long-term horizon. I have ignored the FTSE and have always looked to the US, specifically the S&P 500. As it has provided better results over time. But with the plunge in the value of the pound and the low prices for some major UK companies, is now a good time to invest in blue chip FTSE companies. So, is it?
Well, interesting question. I mean, clearly, in recent years, plumping for the US over the UK, if you're just, investing in passive funds, the US market has clearly done better. It's not done better this year. Because actually the UK market has held up, remarkably well by comparison with the US market and indeed many other stock markets around the world. I think the question of whether now is a good moment to be investing in the UK market is a tricky one because there's a balance here. Yes, the UK market is relatively cheap, and its constituents are in some ways it's well positioned for an inflationary environment due to the nature of the companies within the FTSE 100. That said, I do think that the challenges facing the UK economy, some things we've been discussing, this tension between the government's agenda and the Bank of England's agenda. I think the UK faces some real economic challenges going forward, and so it's been a very defensive market throughout 2022. I wonder whether it will continue to be quite so defensive. So I think I'm a bit more cautious on the UK than maybe I was a year or so ago.
And it once again, it depends on your view of the sort of near-term future, doesn't it? Because if the trends that we've seen, higher commodity prices, energy prices, a weak pound, if they continue, then the FTSE 100, which is what this question is asking about, those blue chip companies, very international facing, earn a lot of their money overseas, not in pounds and pence, they will look strong versus other markets.
Yes, so you're making an assumption there about the continued weakening of the pound. The pound has fallen a long way already, so I'm not sure that when the pound was at $1.30, then that might have been a reasonable assumption that the pound would depreciate from there. I think at $1.10, it's not quite so obvious that is the future path for the pound.
Okay. Well, Tom, let's move on for now to a question about retirement planning. Actually, it says this: is now a good time to consider annuities as part of retirement planning, or could these increase further if interest rates increase in the coming months?
Well, I mean that's a question with a similar answer actually to the first question about bonds, because the key determinant of the returns that you can achieve with annuities are the level of interest rates and bond yields, and as those have risen, so the returns that you are able to lock in with an annuity, because essentially that's what you do with an annuity, you lock in a return effectively for the rest of your life, they look more attractive now than they have done for many years. I think the way I look at annuities is that they are part of the overall sort of package, the armoury that you have to manage your retirement. You may not want to put all your money in an annuity. You may want to use an annuity to cover off maybe your essential outgoings. Maybe later on in your retirement, let's say you're retiring at 60, you may not want to buy an annuity at 60, but you may want to buy it when you're 70, when incidentally you'll get a much higher rate of return because you are likely to live for less long. So I think they become part of the overall package in a way that for many years they haven't. For many years we've just said, don't bother with annuities. Why would you bother?
Yeah.
Now I think they look, a genuinely interesting part of it.
Quite. I mean, the point I would make here is, you're right. They just didn't look all that attractive when you could consider that the returns they were paying weren't better than the assumed returns from drawdown, leaving your money invested. And you don't have to give your money over when you're in drawdown. So that was very attractive for lots of people. This does, I would say, change the picture. But what really occurred to me with this question is that, of course, let's not pretend that, I'm not about to buy an annuity. You have to be in the position of funding your retirement to be able to buy an annuity. And what you say there, Tom, about trying as best you can to pick your moment to annuitize if that's going to be suitable for you, you need to build in some flex into your plans, I would say. And if you can, so that you can take advantage of these market movements when they come along. I mean, we don't get a choice sometimes about when we want to retire or what the market conditions are when that happens. But if you have some flexibility, you might be able to nudge things in your favour at times like this.
Yeah, and the other thing to bear in mind with annuities, it's not just a sort of purely mathematical or sort of factual consideration. There's a sort of temperamental thing as well that, when you're 60, you may think, oh, I'm really interested in the stock market and I want to spend some time managing my investments. When you're 80, you may feel rather differently. You might actually find it a bit of a concern, a bit of a worry, and the prospect of simply having a regular income coming in for the rest of your life may seem rather attractive. So I think things change over time. Yeah,
and we should always make the point here when it comes to retirement planning, there is help available. There's services like the government's pension-wise service, and there's of course professional advice that people can take if they have anything like a complicated set of circumstances and they're unsure about how they can blend all these different income options together. An advisor can help.
Yes, and if there's ever a time when advice has a real value, then it's that moment when you're coming up to retirement, because there are many options that you can take and many things which you may not be able to undo. It's a really good time to take advice.
Yeah. Okay, well, let's move on again, Tom. And this question actually echoes many that we got, really. And it says this: with fixed rate savings accounts offering over 4%, am I better off moving my stocks and shares ISA into a cash ISA, given the added security and peace of mind? So,
well, again, it's the same question, isn't it? It's about peace of mind. It's there's a trade-off. Yes, you can get in the short term what looks like a reasonably attractive income from your money, but let's remember that 4% is still less than the current rate of inflation. And so, let's assume that we move into a more sustainably inflationary environment. Then, you may not want your money to be eroded, chipped away year in, year out. So, maybe there's a place for some of your money being in cash, but, over the long run, depending on how long your investment horizon is, shares have delivered a better return in real inflation-adjusted terms than cash has.
Yeah, a couple of things jumped out at me reading this question. I mean, clearly it's going to be on people's minds when returns on cash increase. 4%, we haven't seen those kind of rates on cash for a long, long time. 4% will be often what people want from their investments and savings, to fund retirement or whatever it is. That'll do to a lot of people in their minds. But the point you make about inflation is really, really important, isn't it? The difference between returns on cash and inflation now, notwithstanding the fact cash rates are high, the difference is much bigger now than it was a year ago. And a year ago, we were all complaining that cash rates are very, very low. But they were still closer to the rate of inflation than we have we have now. So it's a difficult message for people to compute, because I think even if we know the dangers of inflation, we still think about that notional cash return, and it's attractive, and it's difficult to alter your thinking.
And one other point that I would make about cash is that we tend to think about the attractions of parking our money in cash at precisely the moment when alternatives like the stock market are not doing very well,
yes.
and we feel negatively about the stock market, and we know that those are precisely the moments when you should start to get interested in the stock market, because we are attracted to the idea of parking our money in a safe haven like cash when the stock market has fallen, and that of course is when the stock market tends to rise.
And of course this question is asking about selling down their stocks and shares ISAs to go into cash. So that's a very sort of on the nose example of that, isn't it? You selling now means selling at a loss, and
potentially it certainly means selling after a fall in the
yes,
market,
indeed.
which you may not want to do.
Okay, the next question, Tom, is personal to you. It says this: Hello, Tom. What are the top 3 things that you would be doing or not doing with your own money investment-wise over the next 6 months? You don't have to tell me 3 things, Tom. You can tell me 1 if you'd like. But is there anything that you have planned for your own finances?
Well, I think, and it follows on from the previous question and answer, really, because one of the sort of wisest things that anyone's ever told me about the stock market is that you should avoid the temptation to become more bearish, more negative about the stock market as it falls, because because that is human nature. That's what we do. As the market falls, we tend to look for safe havens and to protect ourselves from that. It's the opposite. That's the time when you should be getting interested, because that's when the potential returns from the stock market are better. And I think it's entirely possible that we're not at the bottom of the stock market after what's been a very difficult 9 months in the stock market. We may have a little further to go, depending on what happens with company earnings and valuation multiples. We may not be at the bottom, but we're clearly, almost by definition, closer to the bottom than we were. So, to answer the question, I am starting to look at opportunities. Where can I start putting money to work in the stock market? Not all at once, because I don't think we're at the bottom, but over a period of time, to start dripping money back into the market to take advantage of the recovery, which in due course would come, I'm quite sure.
Yeah, and I put you on the spot, so I think it's only fair if I answer as well for my part. It echoes what you've said there. I'm going to try and remember some of those principles that we talk about all the time, we write about, and broadly speaking, I do try and stick to. But the last year has been difficult to do that, particularly around phasing money in and out and not wanting to invest into a falling market because it feels so
difficult.
It's difficult. It feels like you're immediately losing money. That's certainly been the case here and there. But I know the rational case for investing. Precisely when the market is like this is when, as a long-term investor, you actually build up potential for the future and those future gains.
Yeah. And it's very hard to do.
Yeah.
Psychologically, it's very hard to do. And that is why I'm quite sure that, now and over the weeks and months to come, we'll be talking a lot about this, because I think that it's really important that people grit their teeth and try and take advantage of this situation.
Okay. Well, 2 more questions if I can, Tom. The penultimate question today is this: why have ESG and infrastructure funds done so poorly over the last year, and will they pick up? So what do you have to say there?
Yeah, well, I think they're probably 2 different questions there. I think ESG funds have done not very well for quite a simple reason, and that's because many ESG funds are over-indexed or heavily indexed towards technology stocks, because they're not dirty stocks, they're not oil and gas, they're not commodities, they're not tobacco. There have been a lot of technology stocks within ESG funds, and technology has not done well because of the movement in interest rates, which makes their high valuations seem even more high than otherwise. So I think that's actually nothing to do with ESG. It's a side effect of of the kinds of companies that ESG investors have invested in. I think infrastructure, I think it's I suspect that some infrastructure funds have done quite well, and I think that as governments look to have looked to level up, have looked to invest more money. I think that will continue to be an interesting. It's a great source of income. Government-derived revenue streams can produce a very useful source of income for investors. So I think they're probably different questions there.
Okay. Well, let's move to the final question today, Tom. Perhaps the most important question today in terms of the immediate prospects for the stock market, and it is this: how vulnerable are US equity valuations to earnings season?
Very, I'd say, and that's because what we've seen so far this year is a compression of valuations, a reduction in valuations. So the multiple of earnings which investors are prepared to pay to buy a share, it's fallen from around 23 or 24 times earnings to about 15 times earnings. That's only one half of the calculation. The other half of the calculation is what those earnings actually are. And earnings have held up pretty well. So we've had the reduction in valuations. We haven't yet had the reduction in earnings. If we see earnings fall, if we see company results being delivered below expectations, then I think the market may have a bit further to fall. If earnings hold up, then I think that correction in valuations may have already done the job.
Yeah. So
that's why I think that the earnings season, which actually begins this week and will continue for the next 3 or 4 weeks, is really crucial. If we can see a stabilisation in earnings, then I think the market might level out. So I think people will be watching very closely to see whether companies are delivering according to expectations.
And as you say there, the market has priced in some fall in earnings. I mean, that's what it does when it falls. It sort of predicts the prospects for the future, and the market level will fall. And then earnings, if they are affected in this lower growth, less economic activity, they will fall. So there could be some fall in earnings without it being a big disappointment to the market, but there will be a level at which the market does become disappointed.
Yes, and the key point to make is that market prices tend to move ahead of the earnings cycle. So what you'll find is when earnings really do bottom out, the market will have already got there, probably 6 months ahead of that, and the market will have already started to rise. So it's good to keep an eye on earnings, but it's also good to realise that the market will have anticipated that well ahead of time and may already have started moving.
Okay. Well, that is all the time that we have now for questions. Thanks to Tom for joining us today to answer them. If you asked us a question that we didn't get round to answering, we have a special edition of the Personal Investor Podcast, which will answer yet more of those questions. You can listen to that on iTunes or wherever you get your podcasts. A full copy of Tom's investment outlook is available at fidelity.co.uk/outlook. Thank you so much for watching today, and do join us again next time. Bye for now.